But since we are in Pretoria and Tshwane City, Ache, Goeiemorgen, good morning. And for our visitors from the coast, Sanibonani, Molweni, Manene guys. So welcome to this very exciting topic on costs and their implications on the retirement funds industry. I hope that it will bring up a lot of debate. I've got a very esteemed panel flanking me on either side. I was actually noting, if you read in all the bios, I think we've got probably over 120 years combined financial sector and retirement funds experience, but that doesn't give away our age at all. Okay, but really, very esteemed panelists. Really, I feel very humbled to be in their presence today, and thank you again for coming and joining us at our inaugural session. I think the whole issue of costs, and I think sometimes we've rehashed this topic quite a few times, and we're saying, can we now put costs into the context of value for money for our members? You know, when a pensioner cannot stretch their pension to that last amount to buy groceries or medicine, cost becomes an issue. So for us here in this industry, maybe it's a question of, it's a very technical discussion, it's a very regulatory discussion, but for the pensioner and the member at the end of the day, it's a very emotive discussion. And I hope that this panel today will really address the issues of mind and heart around pensions and savings and just making sure that that pot lasts. Because if you ask anyone in the street, do they have enough to retire on, we all know what the answer will be even before it's been asked. So I'm going to ask my panel members just to briefly introduce themselves. The rest is in the bio. Just tell us what they're currently doing. So I'm going to start on my extreme right with Mabatho Seeiso.
Good morning, everyone. I am an independent trustee on a number of funds.
Morning, I'm Stephen Nathan, the founder of 10X Investments.
Good morning, everyone. Thanks for having me. I'm Kirshni Totaram, and I'm from Coronation Fund Managers.
Good morning, everyone. I'm not going to reiterate what's in the bio in your handout. My name is Nerina Visser. I do wear a number of hats, but I think for me, the most important one here today is that I'm passionate about allowing our members and our people to retire comfortably, and that's really the biggest hat that I'm wearing today.
Morning, everyone. I'm Rowan from Momentum Investments. I sit on a number of different industry panels, and so I'm really representing industry players today rather than necessarily the industry itself or my employer.
So let's kick off straight away. So from the FSCA, we receive quite a lot of financial statements, statistics, and quarterly reports from over 1,300 active funds. That's as at current statistics. So what does this tell us about what the cost drivers are in relation to expenses? So those asset-based fees, contribution-based fees, fees from benefit payments, fees from transfers, and I'll touch a little bit now on the market value adjuster, which we often see when there are transfers and what must be communicated to members, those investment fees, the fair value adjustments, and then the big ticket item, the administration fees. So in there we have the admin fee, which is normally the 13B administration fees, audit fees, the actuarial fees for those funds that are still subject to valuation, or those funds that opt to do their voluntary valuation, actuarial reports, basically because they have some reserves that they're running, or there might be a hybrid fund that's not exempted. And then obviously FSCA fees, which could include levies, penalties and service fees, secretarial fees, consulting fees, training and trustee expenses and remuneration, as well as principal officer remuneration, legal fees. And then the one item that we often see is the other at the bottom. And that worries us, because sometimes the other is bigger than everything else. And we're saying you can't put this as a slush fund, ladies and gentlemen. You need to specify. Now, when we open up, when we become intrusive and intensive, what do we find there? Very interesting things. Marketing, eating allowances or stipends or per diem, whatever you call them. They are sort of seating allowances, as some may call them. Travel expenses, which includes flights, accommodations, meals, car hire. So we're seeing a lot of this on the uptick. But the backstop of any fund to be able to manage their expenses is really your expense policy. That's the backstop. If you don't have that in your fund, maybe by show of hands, who does? Thank you very much. We'll teach the others how to do it. Then Directive 8, ladies and gentlemen. So it's very important that when some of these costs are indirectly going to be passed onto the fund through the admin fee. So we won't see it necessarily in the fund's expense account, all this entertainment and so on, but we will look to my colleague from the 13B administration section under conduct of business, where that has been embedded in the administrator's costs, because at the end of the day, the member is going to pay. And I think that's just with every taxpayer as well. We know that eventually the incidence or the burden falls on the member. Just a quick table. You will hear a lot about total expense ratios today, total investment ratios. And all we're saying is that there's three main items that you can take away today. It will be these three concepts: total expense ratios, or TIR, and effective annual cost, EAC. So if you forget everything else, please remember those three, because you need to be asking questions around that. All right. I'm going to hand over to Mabatho Seeiso, so she will give us her opening remarks and also take us through some of the questions that I'll be posing to her. So you will be getting access to these slides. Don't worry too much. We'd rather get the debate going at the end of the session. Thank you.
Thank you, Wilma. So I hope that what my remarks will be is to give a practical example or or to talk about the real experiences we have as trustees on pension funds. So I'm going to start off with, just the basics on what is our fiduciary duties as trustees. And I know everybody knows this, but every now and then it's good to be reminded of what they are. One is to safeguard our members' benefits. Very often we'll find that a number of our members, this is the only pot of savings, meaningful pot of savings that members will have. So the idea is to make sure that we're not destroying value. So we're safeguarding, and how we manage costs is going to be an important part of how we safeguard members' benefits. The second part of it is around making sure that we then grow this pot so that our members at retirement have sufficient money to retire. Now, I know there are other things that go into this, but partly it's also to make sure that they have enough money to retire on. I just want to say as a trustee, it often feels like you have to have the wisdom of Solomon to do your job. Because the complexity of the environment and the products that we deal with means you really have to get to grips with what you're dealing with. And very often there is an information gap that exists to allow trustees to make informed decisions, to be able to compare in order to manage those costs. I'm hoping part of our session today will be really helping trustees understand what it is to look out for. I think the theme, what we can agree on, and what studies have shown, is that we are behind the curve as South Africa in terms of costs for our membership in the retirement industry. The trend, we are moving in the right directions, costs are coming down, but we still have some way to go. The question is, how do we then keep managing costs so that, or having the right conversations? I had the view around asking the right questions so we keep moving in the right direction. So I'm going to leave it there as an opening remark.
Thank you very much, Mabatho. So my first question to you today is, are trustees asking the right questions, and are they being decisive enough in reducing costs?
So I think one of the things that I spoke about is there is an information gap. And so very often trustees don't know what to ask for, and they don't know where to look to benchmark. One of the things that trustees need to be careful not to be is to be price takers, that they are able to negotiate fees. I think many trustees don't think it is part and parcel of what they are able to do is to negotiate the fees that they see in front of them. So, and to do that, you need to understand where to find the information. I'm glad, Wilma, you're talking about publishing studies that will help so that people can see on a relative basis what is happening. I also know that there are benchmarks that are published by people like Alexander Forbes, and there are benchmarks that are published by Sanlam. But I think the question is always, where do you get this? I did put a bit of an example just to show people how varied costs can be on just one thing. The Sanlam benchmark on just money market funds showed that money market funds can range from 0.16% to 0.24%. But I've seen costs that funds incur up to 50 basis points in a money market fund. 50 basis points, and it's not a story, it's real. And how does this occur? Sometimes it occurs because, one, I'm a retail investor, so even if I'm a big fund, and this 50 basis point I saw was in a fund that's above 5 billion, you'd assume that a fund that big, you wouldn't have costs that are like that, even if it's a money market fund. But so I can understand how the regulator, with all these default regulations, are trying to help us to manage costs, because they're then saying it's better to be an institutional investor than a retail investor, because then there is muscle in terms of negotiating what those fees are. But I also want to say that I know one of the things that they say that they're trying to push us to is in terms of transparency. But can I say transparency is not enough to reduce costs? I'm just saying to trustees, just because people are being transparent doesn't mean they're going to charge you less. When I had a conversation with somebody who I thought was a decision maker, where they were charging people 50 basis points on money market, and I said to them, but how can you justify that? The answer was, well, we've told them, you know. The FACE ombuds used to say to me, you have a choice when you understand what your options are. And in the retail, people I think understand that people don't understand what the options are, and so they can get away with it. So I can understand the whole drive around building scale so that we can negotiate better fees. But I also now just want to talk about there's so many different options that we have available to us and that have a serious impact on costs. Olana spoke about, and I'm sure you're going to speak about passive, that we must, and in our default portfolios, we're supposed to be considering passive investments. Sometimes things are not black and white, there are gray areas. I think it's about understanding the dynamics of whatever decisions and products that you're choosing. Passive costs less, and I think we've heard that most asset managers have not been able to add active alpha, so passive is better. But in the South African context as well, we have concentration risk. So, you know, it's how do you compare the different things, and what does that mean? There's concentration risk, and therefore, sometimes when you do go passive, there is a belief that sometimes you are increasing risk, and therefore you would not have been able to avoid things like Steinhoff having a serious impact on funds. I mean, one of the statistics I saw around the concentration on some of these indices, that in the SWIX, I think 15 stocks make up around about 79% of the market cap of the SWIX. So I think those are some of the things that you need to think about. It's not straightforward cost. It's about cost and value. So you have to weigh both. I'm not saying there's a right or wrong, but I'm just saying weigh both. Active management we've spoken about. I've seen in some funds where the default portfolio is smooth bonus funds. Now, sometimes people will reject smooth bonus funds on the face of it. I must say I've seen smooth bonus funds that perform well. They've actually performed relatively better than normal balanced funds, and partly it's because of the diversification that exists in those funds. So it's not just your traditional asset classes that have struggled with performance at the moment, but they have allocation to infrastructure, they have allocation to Africa, they have allocation to impact investing, and that's where the yield has come from. But again, you need to understand when you are in those sort of investment products, that there are costs. So the capital guarantee is costly. And should you not want to be in that smooth bonus funds, maybe after 2 or 3 years, you may come out of that fund in an underfunded position. So I think for trustees, it's not right or wrong. It's understanding the trade-offs between the different decisions that you make. And depending on what sort of fund you're in, you may also find that it's not just it's just not asset management fees also. In some portfolios, I also do find sometimes in umbrella funds, they have structured products as well. So you'll pay an asset management fee, you'll pay a platform fee, you will pay a structuring fee. And so you need to be able to unpack all of that. It's not right or wrong, it's understanding what you're getting into and doing the relative value for money, that comparison that you need to do.
Thanks, Mabatho. Now, my last two questions to you is really, and I know you touched a little bit about building scale and economies of scale. So let me start with that question as well. Many funds are making the decision to move to umbrella funds. What are the types of costs that they should assess and analyze in making decisions on which umbrella fund to switch to? And then my last question to you is, what factors influence costs on funds, and do they differ depending on the type of funds? For example, union funds, standalone funds, and umbrella funds. And I know you touched a little bit about the type of funds, but maybe in relation to the different types of funds, maybe you can just give us some examples. Thank you.
Yeah, I think I mentioned a little bit in terms of the one thing that, and I'm happy, even the facilitator spoke about transparency. One of the biggest challenges we've had as trustees in making decisions is comparing. One of the things, when you decide which umbrella fund you want to go to, make sure that you are comparing like with like. So in other words, how people give you information, make sure it's comparable, because sometimes you're comparing an apple with an orange and it's not quite the same thing. The charges and costs have been quite opaque for a long time. Sometimes you find that you're not too sure about some of the things that I spoke about, platform fees, structuring fees. Can you unpack all the fees that are charged by the different umbrella funds? I think that's going to be important. We speak about costs in terms of maybe direct costs, but there's also another cost that I think we're not really speaking to. And it also relates maybe to sustainability investments. And that is the cost of not meeting our members' liabilities. There's a reason why we have a benchmark. Everybody is so happy to say our performance is 4% and for the year, and we're happy because everybody's doing 4%. But my point is, what are we doing to make sure that we are generating the sort of returns to our members? Because there's a cost to members if they can't retire at the level that they need to, because we are not meeting our obligations. And so I think part of it is understanding the investment choices and decisions that you have on your platform or umbrella fund that you're going to, and the performance, and start asking the questions around impact in investing, infrastructure and so on, because actually that's where you're going to get the yield pickup. I know when we used to talk about investment, they used to say, avoid things that you don't know, but I'm saying to trustees, do the work so that you are able to assess the whole investment universe so that your members can benefit. So these are the sort of things that you need to assess when you're talking to your members, and make sure you push them to do the things that are important to you, whether it's on transformation and so on. So I think at this point, the other thing that I need to say in terms of choosing umbrella funds.
I've just asked that we speak into the mic, because I think at the back it can't
They can't
be
hear.
heard.
Okay,
Yeah.
okay. When choosing umbrella funds, so I think a lot of the things that I focus about is I've spoken about safeguarding members' benefits. The one thing that as a trustee, sitting on trustee boards, that I've become passionate about is a whole issue of people saving their money. And then after a while, either they or their beneficiaries have no access. What is the point? So there is a direct cost to members if they have no access to the benefits that they spend such a long time saving for, and that goes to unclaimed benefits. So when you choose a fund, and often umbrella funds will have an unclaimed benefits part to them as well, and we decide to take them there. Ask the right questions. What is your success rate in finding members? The other day I was talking to a provider who was so proud that at least they find 50% of their membership, whereas the average unclaimed funds 25%. Having served on an unclaimed fund and served on some of the union funds, I know it's just not enough just to have tracers going out. There's got to be a concerted strategy and effort to find members. So I'm just saying to trustees, we all need to be asking the right questions to drive the right behavior. Very often there's a natural tension between what's in the interest of members and what's in the interest of the sponsor and managing those. It's when we ask the right questions that will make sure the interest of members can overtake the interest of sponsors. We heard earlier that companies exist, and actually when you go to the IODSA, they'll tell you companies exist to make profits for shareholders. That makes, very often there's a natural tension between that and the cost that you get, and the need for you to reduce costs for your members as trustees.
Okay. Thank you very much, Mabatho. And I know you've probably already spoken to your next two slides, so thank you very much for that. I will now hand over to Stephen Nathan to give us his opening remarks, and then after that I will just pose his questions to him.
Thank you. It's always nerve-wracking for me when I get an email from the FSCA because, we do upset people from time to time, not really investors, but so I was really relieved and grateful that this email from the FSCA was to come and talk at this conference. So thank you very much for that opportunity. I'm going to talk about why costs matter. And on the one hand, pension funds are very complicated and you can get lost in the detail. But on the other hand, they're actually quite simple. And if you want to retire adequately, you've got to do four things right. You've got to save enough money. You have to save for long enough. So we say 15% for 40 years. You have to invest for growth, and you have to minimize fees. Those are the four things that matter. Now, the first two is up to the member to do. Obviously, we can nudge, but really the industry's primary role is to manage returns and manage costs. And it's about it's an and, not an or. You've got to get all four things right, because if you get one of those wrong, it can derail everything. So costs matter because if you look at returns are finite. Before I understood investing, I thought there was some magic to returns, that someone creates a return. There's some David Copperfield or, someone out there. It's not. The returns are finite. And as fund managers, we don't create the return. We're not manufacturers. Okay. So fund managers come and talk to you and they sell you lovely stories as if they're creating the return. We don't create the return. We're a service industry. All we do is take your savings and invest them in the investment markets. We create no return. If you look at long-term, a balanced portfolio in South Africa going back 100 years, the return has been quite constant on average between inflation plus 6 to 7%. It's varied. Inflation plus 6 to 7. Now you can say, well, going forward, maybe we're a little bit more conservative, so we should be looking at inflation plus 6. Now, no fund manager, no balanced fund, or hardly any balanced fund, over the last 5 years has beaten cash. Okay. And that tells you that fund managers don't create return, and we don't really know when markets are going to do well and badly, if you need any evidence of that. So while returns are finite, costs actually are infinite, because very few people know what they are, and you can basically get charged what you want because there's no regulation there. And costs erode enormous value over the long run. If you haven't done any calculations, just look at it. It's mind-boggling. So you've got a finite return, infinite costs. Now, independent studies, and go and Google this please, Morningstar amongst others, have shown that the single biggest predictor of a fund's future investment performance is costs. Over all periods that they've done, funds with high expenses produce below average returns, and funds with low expenses produce above average returns. Obviously there's outliers, but overwhelmingly that's the issue. Now, member costs equals industry revenues. There's an inherent conflict between us as an industry and members. I mean, if you can't see that, you've got to be incredibly skeptical. You should treat us as guilty until we can prove otherwise. Warren Buffett has said, don't ask a barber if you need a haircut. So, you've got to be incredibly mindful and skeptical of that. Okay, so what do members pay? I have seen, I don't know how many funds, but take it as a lot of funds. Umbrella, standalone, you name it. So the first thing is, what do members pay for? Well, members need three services by and large. They need administration, which is individual member record keeping. This is very hard. This is where a lot of people are involved, and operational risk is high, and administrators have PI claims, and it's a very expensive area. I mean, just as an example, anecdotally, I don't know the exact numbers, but Alan Gray, I think they employ about 1,500 people. They have 4 fund managers. There's only 4 people that actually make investment decisions. What are the vast majority of their people doing? They are in the administration of the list platform and the administration side. Okay, so if you look at and you understand that difference, it is enormous. Then we have consulting, where you consult to a fund, and then the investment managers, we manage pools of assets. We don't know who the individuals are. We manage buckets of assets. So if you look at it from what the member needs versus what they pay for. So here's a case study. It's a standalone fund, $1 billion of assets, 4,000 members. Their total fees as a percentage of assets is 1.4%. Okay, that is high, but that's terrible. So if you can see it, so the blue's for the investment management. So almost 80% of the fees they pay is for investment management. 6% is for consulting, and administration's 15%. Now, the asset fees, there's local, there's international, there's performance fees, there's platform fees, there's consulting fees. So you've got to ask yourself, are members paying for the right thing? Is it right that about 80% of fees should be paid towards assets and a much smaller amount to admin and consulting? Now, this is what I estimate. The industry costs are about 70% for administration, 20% for asset management, and 10% for consulting. And I just want to say that this is not an active versus passive debate. Okay, it's a red herring, in my opinion, active versus passive. It doesn't take many people to manage a fund. Okay, you can have one portfolio manager managing a fund. You don't need 50 or 100 or, as I said, if you look at the big funds, there's unit trusts in South Africa, balanced funds, that have got over 100 billion of assets, and their expense ratios are over 1.5%. And the expense ratio was 1.5% when it was 1 billion. So you can have single funds that are generating over R1 billion of revenue. It's not an active versus passive debate. Okay, and I would encourage you to form your own opinion on that. So there's 2 problems. Fees are too high across the industry, and secondly, there's a misallocation. And as trustees, you determine where the fees go, because you've got to ask yourself, are we paying the right people for the right services for our members? And even if you look at our panel with respect to myself and my colleagues, why are we as asset managers up here? We're the administrators, we're the people who do the hard work in pension funds and that manage with the individual member queries and all of these issues. They're not here. And it partly talks to this whole obsession we have, in my opinion, with asset management and a misallocation of fees, and our members suffer at the end of it. Thank you.
Thank you very much, Stephen. And I think it's a fresh new approach and very much different to what the industry has been debating over the last 30 years. I mean, one of the points you raise is this whole mystery that in the good years, it's the skill of the asset managers, and in the bad years, it's the market. So now you want to have your cake and eat it. So what I'm saying, and that is just to quote Mr. Elias Masilela when he was still DDG at Treasury. So what we're saying now is, are we not flipping this whole thing on its head and saying, actually, asset managers don't create the returns, or alpha, or whatever you want to call it? Is it not the market? So I'm very excited now to hear from Kirshni, because she's obviously got a very fresh opinion of her own. And then, as we say, you be the judge. Thank you.
Thank you, Wilma. Thank you. I think the first thing, when I was asked by Wilma to speak, and she told me the topic was cost and its implication in retirement savings, the first thing I said to her, well, I think that's the wrong question. I think the right question that we need to be asking, something I feel very strongly about, is achieving value for money and what implication that has on retirement savings. Because, and the reason I say this, a focus on costs in isolation of value add, and we can talk about the definition of value add, but a focus on cost in isolation of that, I think, can be very dangerous and can lead to massive unintended consequence, the biggest of which is that we do not provide adequate income in retirement, and we actually fail to provide good outcomes. And one of the key things that happens with costs, and like Stephen said, we get this extreme focus on the explicit costs of that are disclosed by service providers across the value chain. And yes, we should be looking at it, and we should be looking at it in detail. But costs that are incurred within a retirement fund are also your non-visible costs. And your non-visible costs are market impact costs, they are trading costs, and they also costs where, if you listen to the first panel discussion, the costs that a fund can have by having exposure to what could be potential future stranded assets as a result of the climate crisis. So taking all of that into account is actually quite critical. And when Wilma put up a table earlier, she showed the cost structures that you actually had between the different funds disclosed. And I think it's critical and important that we pay attention to these levels. But looking at those levels of costs without commensurately looking at the return that has been generated for members, or the value that has been generated for members with that associated cost, I think is quite dangerous. So if you're comparing Fund A and Fund B, Fund A, which has a total cost of 50 basis points, let's say, but produces a return of 5% per annum over a 10, 20, 30-year period. And you've got Fund B that has a 1% cost, but has actually produced 8% per annum over that 30-year period. Fund B's actually done a better job. So let's not just focus on one side, it's a holistic picture. The other thing that I actually wanted to mention, which is something that Alana said earlier that resonated quite strongly, is that I agree with him. I don't think we have a broken system. I agree that member outcomes are best served by an open, competitive, transparent and well-regulated industry that has low barriers to entry. And by and large, we have some problems in South Africa, there's no doubt, and there's room for improvement. But by and large, we tick all of those boxes. And I'm going to show a couple of illustrations where we have done a good job in the retirement fund space in actually providing good value for money for members. When I talk about value for money, what am I actually talking about? Here I really do think range of the services, the quality of the services, the breadth of the services that you get are actually quite important. Now, each retirement fund is going to have their own definition, their investment policy statement, their value statement, their belief statement on what it is that they need to produce for their members over the long term. And by and large, that's going to dictate what they believe, and in assessing the different service providers, what value for money is. I totally agree. I resonate or reiterate what the other panel members have said, that misaligned and inappropriate costs can have a material impact on the retirement outcome, and that is not acceptable, and that is what we really do need to pin down. But when I think about what is our retirement challenge, well, I think our retirement challenge, taking on from the earlier segment, how I talk about it when I'm asked by clients both in South Africa and globally, is that I think it is about producing an adequate retirement income in a world worth living in. So 20 years ago, 25 years ago, when I started in the industry, it was all about financial return and risk. That's all. It was a 2D issue. Today, it is very much a 3D issue, dictated largely by members of retirement funds, where it is not just about the financial returns, net of costs, but also the social imperative that stewardship, governance, risk management are playing in providing an income in an environment that is a world worth living in. And I think I talk about Mabatho's earlier comment that costs have come down. Globally and across the industry, costs have come down, and that's important. So the direction of travel is in the right direction. Part of it has been because of regulatory impact, where the regulator has talked about consolidation within the industry. We've come down from 13,000 funds to below 2,000. Those economies of scale help extract value for money for members. We've seen it. Competition has done part of it. So I think there's been a huge improvement there, and that's a good thing. Doesn't mean we rest on our laurels, but the direction of travel has been good. When someone asks me, okay, you talk about value for money, you're an active manager. I like to call ourselves judgment-based managers, because I think all investment decisions, whether they're made by a board of trustees or an investment manager, are active. You make an active decision at every point of the way. But when I look at judgment-based investing, let's talk about the various components of value add. The first part of the problem is, or first part of it is financial return. Do I believe that there is some benefit, financial uplift, that can come net of fees? And here I really just did a very simple illustration that Wilma asked for, is to say that if you actually had a retirement fund and you were able to achieve an outperformance of a market of 1% per annum net of costs, that your compounded impact of return over 30 to 40 years, which is the investment time horizon, and with the start or the compulsion on funds to provide some sort of preservation option, I feel like that 30 to 40 year period is far more imperative, because people choose to leave their money if they don't really need it. And that uplift in return is something like 45% higher. Now, in a low return environment, in a DC world where I, as the member, take on the ultimate risk of adequate retirement provision, I don't think that this can be sneezed at. But in conjunction with that, what are you also getting? You're getting where Stephen talked about returns are finite. Well, I don't believe that. We believe that a key part of capital markets, active allocation within capital markets, is not only price discovery, but it is improving the overall outcome that you actually get from the market. South Africa has about 100 investable shares. It is important that as market participant that we actually engage and change behavior so that we actually increase the overall returns. Part of a global think tank that I belong to talks about the fact that if collaboratively we can get together as an industry globally, we can increase the beta. And what that really means is we can lift up the overall returns that we can generate from markets, from companies, and ultimately it does actually provide a better outcome to members. And then one other thing that I wanted to talk about is the fact that we do talk about costs. And we must consider the fact that costs are made up of a multiple of different components. It has a number of different components. And we've seen regulation bring down costs quite substantially. Now, I had a lovely slide which talked about whether this industry, I made mention of the fact that I think the South African industry is well run and that we've done a good job, but we'll include it in your packs. And what I did is I went through the 2017 report that was published by the Registrar of Pension Funds, and in addition to that, we went through 6 or 7 annual reports of funds that are greater than 20 billion rand in South Africa. And we looked at the disclosed cost items. Now, there's no doubt that the EAC standard that ASISA and the guidelines that ASISA have put together and comes into effect on the 1st of September will improve this dramatically, and it's a wonderful initiative. So kudos on them, it's a wonderful initiative. But what we looked at is the cost disclosed there, the operational cost, which I'm going to include admin and legal and trustee fees, everything, as well as the investment costs. And the well-run funds in South Africa, both in their disclosed numbers as well as anecdotal evidence in terms of clients that I deal with, actually show that your costs run between 50 to 80 basis points all in. And I think that's actually, those are well-run funds. And what you've seen is it's a variety of different reasons. It could be asset allocation, it could be type of investment approach, whether they've used rules-based or judgment-based investment approaches. It could be the type of fees that they've actually used. And one of the key things that South Africa has done really well is we have some great professional intermediaries who've actually played a crucial role, because there's no service provider in South Africa that is not for profit. We're all for profit, right? So we do need an objective, independent gatekeeper who's going to provide advice to trustee boards and could bridge that gap to provide the skills and the analysis and all of that. And they've negotiated really great aligned fees that actually ensure that when funds do well, only when there's been a delivery of performance. So if you look at a lot of those funds where it's greater than 20 billion rand, the reason some of those investment costs are sitting at 20, 30 basis points at the moment is because many of them have performance-based fees. And you haven't seen, as Stephen has pointed out, over the last 5 years, been very tough in the active management industry, but funds haven't been overpaying for it, and I think that's quite critical. And then the last thing that I actually want to leave with is the fact that also as an industry, it's not just about costs and it's not just about driving those costs down. It's about whether those professional intermediaries have also helped allocate assets appropriately. Because I'm not here to defend any form of investment approach, because I think that ultimately does boil down to the values of a particular fund. But if I just use an independent survey, so not numbers that I've done, I've used Alexander Forbes Large Manager Watch, and in their notes they disclose the median of the balance funds in the industry, but they also disclose the performance of the asset-weighted average. And the asset-weighted average has come in close 70, 80 basis points higher than the median. And if you consider that what we've actually generated is something like 6.5% to 7% real return, and you take into the total cost, not just the investment management fees, but the total cost of some of these larger funds being around 70 basis points, then you've seen that 90% of the real return that has been generated has actually gone to members. And I actually think that that's a great outcome.
Thank you very much, Kirshni. So on my right, you heard that fees are too high. On the left, you've heard fees are relatively good and have improved over time. Members are paying for what they are getting. We will now hear from Nerina Visser. And I think, Nerina, just some of the issues that I'd like you to touch on really for us just briefly is just some of the questions around ETFs versus CISs and segregated portfolios and how those costs are done. A little bit also around cash flows, and then if you could also talk to us about the total expense ratios and the TRRs as well, just to recap for us. And then if you could also just end off by telling us or demystify this topic of smart beta. Thank you very much. It's a mouthful, but I'm sure you can manage.
Thank you, Wilma. I appreciate the opportunity. And yes, I would like to use the opportunity to build on, I think, what all of the previous panelists have already spoken about. So really, I think digging into some of these costs and understanding where are we paying costs, and I think really differentiating within the cost framework of which of the costs that we've got in the overall value chain are unavoidable. And those typically would be regulatory costs, statutory charges, taxes. Even though we are here in a retirement fund conference, there are some taxes that we still have to pay inside retirement funds. Securities transfer tax, for example, VAT. So there's a couple of things that we can't avoid. The second type of costs are the ones that are negotiable or that can actually be managed. And I think typically you find that your asset management fee and your administration fee fall into that category. And I think that's where a lot of the focus has been, but that's not the only area that we need to focus on. There's also the unnecessary fees, and I think those are the easy ones for us to pick off. And for me, top of my list of unnecessary fees are actually performance fees, but we'll leave that topic for another day and not go into that just right now. But so I just wanted to talk to you a little bit about why index tracking investments are more cost efficient than more traditional, as Kirshni has referred to it, as judgment-based investment decisions. And I think typically we tend to focus on the fact that the management fee is so much lower. So it's very easy to look at the typical management fee of a so-called actively versus a so-called passively fund. But you know, that's really actually quite a small aspect of it, because it's really the activity, the level of activity that we have in a fund that typically costs money. It's the frictional cost of transacting, and I'm going to show you a couple of examples to illustrate how important that impact of the frictional cost is, and also then the frequency of transacting. And certainly in the retirement fund space, we are looking at frequency of at least monthly, because our members are making contributions to their pension and retirement funds at least on a monthly basis. And then of course there's also the intra-month activity, which would depend based on the style of investing that you follow. And I think what we're finding is, we've seen over the last 5 years certainly, is that in a low return environment, it is increasingly difficult to add sufficient alpha. So Kirshni showed us some great graphs in terms of the uplift that you can get over the 30-40 year period if you can get a 1% alpha uplift after fees, in excess of fees. But in a low return environment, a single digit return environment, that becomes increasingly difficult to generate. But let's just quickly focus a little bit on the different types of investment vehicles that we have through which we can access investments. And I really just want to talk a little bit about the differences between ETFs, being exchange traded funds, collective investment schemes, CISs, or then segregated portfolios. And I think one of the biggest differentiators in terms of the costs related to these different structures relate to where and when they operate. It is primary market versus secondary market. And what I'm talking about really there is that your CISs and segregated portfolios operate exclusively in the primary market. In other words, for every rand that a member invests into their fund, the fund manager has to go into the underlying market and actually transact, buy the assets, actually invest that money, and there are frictional costs associated with that I'll take you through just in a bit. It's securities transfer tax, for example, your statutory charges related to the stock exchange, straight your investor protection levy and so on. Whereas if you look at your, before I go to that one, in terms of the ETF market, you are primarily operating in the secondary market. In other words, the cost to the investor is just in buying an existing unit of an investment. So those underlying costs in the primary market is something that is carried by the issuer, by the manco that issues the ETF, and it's not for the cost of the investor. And I think these are some of those, coming back to what Mabatho was saying, in terms of we really need to understand these different cost components and understand what impact it has, and see as trustees where do we actually have the ability to make decisions that can actually allow us to reduce overall costs without affecting the value that is being created for our members. So the cost of implementing frequent cash flows significantly erodes value, and I think we have made great progress as an industry moving from TERs, total expense ratios, to TICs, total investment charges that do include the cost of transacting, and of course then in the retirement fund space, the EAC, the effective annual cost. Because for the first time, I think we're starting to get a better sense of what of these implementation costs of investments actually amount to. But just to illustrate this for you through an example, to illustrate how big is this impact of the cash flows. So let's say I want to invest 100 million rand in the all-share index at 5 basis points brokerage. What's my total cost of that? So I think the gut feel, this one's instinctive thinking would be, okay, well, it's obviously the 5 basis points, because surely it's only the brokerage that count for anything. But the reality is actually that it is 31.1 basis points. And what is the biggest component of all of that? That big red block that you see there is STT, securities transfer tax. It's an unavoidable cost. It's not something that we can negotiate away. It is something that is paid on every single transaction that is made on buying a security. So when we look at that cost structure, you see how quickly we move from 5 basis points to 31 basis points of what it actually costs to invest a single investment flow of 100 million rand. But let's go a little bit further and say, well, what if I did not receive that 100 million rand as a single lump sum flow on a single day? What would my cost then amount to? So let's say, for example, I received that as 4 payments of 25 million rand each. Well, in this case, my costs don't increase all that much. Bear in mind that my brokerage, as well as this STT, are percentage-based fees. So these are fees that are just a percentage of the overall cost. So that's where the big part of the 30 basis points come from. The statutory charges, you'll see, is now a slightly thicker grey line that you see there. And our costs now increase to just over 33 basis points. But if I was to receive that 100 million rand as 20 flows of 5 million rand each, look how quickly my costs jump to over 1% to implement that flow. And where does that cost go to? It actually goes to statutory charges. These are JSE fees and levies. These are your straight levies, your investor protection levies and so on, because these things are not a fixed cost and on a percentage basis. They are based on the frequency of transacting. Every time that you transact, you incur certain minimum charges for every single security that you buy. Now, these are the sort of things that I don't think we ever concern ourselves with really as trustees, because we assume that surely that's not an important part of it. But I wanted to highlight for you how quickly costs, a lot of which are largely unavoidable, can spiral out of control. And then we don't know why the total cost end up being 3, 4 or 5% for our investments. So the way that one can actually overcome this is through using a structure such as an ETF, where you are operating in the secondary market and therefore you don't have these frequent costs of transacting all the time. And the cherry on top, an ETF is not a security. It is a unit, a participatory unit in a collective investment scheme. Therefore, there's no STT payable either. So that 25 basis point, that big red block, also disappears. And I think these are some of the things that we need to understand, going back to Mabatho's point of, we need to understand these different costs. I didn't want to overwhelm you with technicalities, but rather just to say these are some of the things that we can understand and actually look for ways to reduce costs overall. And I fully agree with Kirshni. All investing is active. There is no such thing as passive investing. All investing is active. It's the level of activity that we have in a fund that varies. And clearly, as I indicate, it's the level of activity that determines also the level of the costs. So you can start with what is traditionally called passive, which is really just a buy and hold strategy. What I would call low churn active, which is I think what most of us think of as so-called passive investing, which is really your traditional passive, market cap weighted, the SWIX sort of weighting that Mabatho was also referring to. But across that continuum, that spectrum, all the way up to traditional active, bottom-up, judgment-based investment, as Kirshni was talking about it, we've got a full spectrum, and we've got this creep taking place, this innovation creep around this thing called smart beta, that I'm going to talk just a little bit about shortly. But I just wanted to highlight for you here that it is really about the activity level that determines the cost level. So understand that this is not a passive or active. This is a continuum, a spectrum, and understand that the more actively managed, the more activity there is in a fund, necessarily the higher the cost structure of that fund would be. Moving then quickly on to the idea of smart beta and the evolution of so-called passive investment strategies. I think for many people in the room, your view of passive might still be, I think, what was the first generation of so-called passively managed funds, which is really your broad-based equity market indices. These are typically market cap weighted, so size-based, and a lot of the criticism that one sees around so-called passive investments often relate back to this first generation. But the benefit of that first generation really was about the low cost, the transparency, the operational and tax efficiency that we bring into the portfolio. The second generation that we saw after that was really the expansion of passive, so-called passive or index tracking, to other asset classes. So now we can apply indexation beyond equities. So whether we are looking at bond markets, whether we're looking at listed property, or even things like commodities, for example, we are now moving to indices that actually give us exposure to different asset classes. And more importantly, we get access to those via our stock exchange. And I want to go back to the point that Stephen made around the cost of administration. If you think of the cost that it is, and he used the example of Alan Gray, but I think it's indicative across the industry, the cost of administration is a significant component for mancos, whether it's unit trust or segregated portfolio mancos. That cost of administration is enormous. The minute you move that same regulated vehicle, a collective investment scheme, onto the stock exchange straight effectively replaces your back office, your client administration. Collectively as an industry, we have the potential to introduce significant cost savings into our industry by bringing more of our investments onto regulated exchanges, where not only we get the benefit of the cost savings, but we also get the increased regulation around that. Just saying, so yes, the benefit of that second generation, ease of transaction, security of custody, clearing and settlement. The third one then is where this idea of so-called smart beta comes in, and it's really about the evolution to new alternative investment strategies. These are rules-based strategies, contrasting to what Kirshni referred to as judgment-based strategies. Rules-based strategies effectively decide on the rules of engagement prior to the implementation of the fund. And it's really allowed us to now move from performance benchmarks, which is really what the first indices were all about, to these things that I prefer to refer to as allocation guidelines. So guidelines that actually say to you, as the allocator, how much of my assets should be allocated to different assets, securities, asset classes, and so on. Major benefit there, multi-factor performance drivers, and we've got exposure, consistency, and style purity. I know I'm running up against time, so I'm very quickly going to take you just through the classification of smart beta. So factor or strategy or style is probably the one that is best known in terms of smart beta. These type of strategies are specifically designed to provide alpha generating capabilities. So it's capturing a lot of what traditional active management provide for you, but in a rules-based environment. And what you find therefore is that you're obviously now looking for something that is going to give you alpha uplift. And you can correctly evaluate those strategies relative to a traditional market cap weighted index as a benchmark. The caution is these things go through cycles, and the danger of using single factor strategies without properly appreciating what it's all about can be that you fall into the classic trap of selling low and buying high because you're evaluating these strategies on the wrong basis. A very important one for me as an alternative is thematic investment. And thematic investment is, I think, where things like ESG and impact investing, for example, fall into, but it's also where we see things like Sharia compliant investment, ethical investment, and so on. And very importantly, the design and the purpose of these type of strategies is not about producing alpha. You should therefore also never evaluate these strategies against a traditional market cap weighted benchmark, because the purpose of that investment is really the allocation according to a specific set of rules or according to certain criteria, whether those would be impact investing, whether it is Sharia compliant laws, or whether it is ESG factors, for example. And those are really the important things that I wanted to share with you in the very little time that I had available.
Thank you very much, Nerina. And ladies and gentlemen, I know cost is probably a whole day workshop on its own, but let's hand over to our other actuary on the panel today. And Rowan, we've heard about that the frequency of transacting adds to cost. Can you maybe just wrap up for us today, this session, and just tell us, how do we fix the problem? The house is cracking. How do we fix the problem so this house doesn't fall down on us? There's some knowledge asymmetries or gaps. And of course, will competition help? What's the answer? Is it more regulation? Is it more collaboration? So just over to you to wrap up for us.
Thanks, Wilma. Stephen, most people in the audience will recognize me as one of those downtrodden administrators or advisors, so I'd like to stand up for the small guy here. Most of the speakers have spoken about the levels of regulation and reporting that create costs in the system, and I think it's important that we understand that that doesn't always mean that we have profit. Because we're at the CSIR, and there are a whole lot of engineers around us in these buildings, I thought that we should look at what a state looks like, a complex system looks like in equilibrium. And this is important because we're talking about our retirement system and what we do to change our retirement system. And Alano, I'm asking for a little bit of time, and I know that your nudging is working, and we're happy to help you with the politicians in that score. But when you have a system and you're looking to try and prod the system in a certain direction, there are trade-offs. It's very difficult and nearly impossible to try and get an efficient system, a system of great quality, and a system that covers all people all at the same time. So what I mean is, if we've got a fisherman sitting in Alexander Bay, he's a seasonal fisherman, we can try and get a retirement product to him, right? But if there's a cost cap, it's not going to be a great one. If we have to give him a retirement product of great quality, it's going to be expensive. And if there's a cost cap and it has to be of a certain quality, we're not going to cover him at all. So I think that there's a trade-off in our system that we need to talk about, which is the costs, the service, and the coverage issue. I think that there are certain non-negotiables in our system. Ours is a complex system, and those of us that are sitting on the stage here are experts, and our clients, the members, do not understand our system to the extent that we do. So we have to have regulation. The question is, what's the appropriate level of regulation? Disclosure is critical, but I added knowledge there, and after Mabatho's comment, maybe I should have written wisdom. It's one thing to know that you're paying 50 bips for a money market account. It's the wisdom to know whether that's reasonable or not. I think communication is really important, and I'll explain that in the next slide. And the next thing that we need to see in our system is portability. We need to see people voting with their feet. There needs to be strong competition in the market, and as Kirshni indicated, that's how we'll know things are working. I think when we start to look at our system and we compare it with costs around the world, it's quite frustrating because we get compared to first world countries and systems like the Australian superannuation systems, which are compulsory systems. Ours is a voluntary tax incentivized system. We've got to get people to join. It isn't a mandated system. If our system had compulsory preservation, we'd have 3 times the assets in our system. So then our cost comparisons would look fantastic. Our conversation around impact investing and prescribed assets in terms of making this country work off that savings pool would be very different. And so these are policy conversations that we need to have. And we also need to understand that there were certain policy directives that have created outcomes in our market. So it was very clear 10 years ago when we had 13,000 funds that there were way too many funds. We now have 1,300. That's a fantastic outcome, right? We need to recognize that. But there's certain other policy outcomes that I'll touch on as a consequence of that. And so now let's start to look at our system and figure out where we need to prod and where the appropriate regulation is. And my appeal now is let's have a look at adequacy and coverage in our system. Like Stephen, there's a bit of a challenge here, but what I've got is for the first time we have data from SARS on pension and provident fund contributions. Because of the change in the tax advice, previously it was just on the employer side. We only have 4.7 million South Africans recorded by SARS as claiming a tax deduction in this last year. Right? We think that there are 9 million records. We think that there are about 6 million people in the system. There may be less than 6 million. There are 9 million records because people like me have 5 different pots because we have a pension and a provident system and preservation funds and retirement annuities. Is that level of cost that makes sense to the member? I have to try and explain to my mother how that all works, and I get that sort of blank face like, you know, when I tried to explain it to her I didn't do my homework. So coverage is the problem. But understand for these higher earners here, so the horizontal axis is salary, there's reasonable coverage, there's our gap, informal workers, lower paid workers. In industries where there's high unionization, we have reasonable coverage at least, that the unions are able to sort of prod employers to providing funds. Then let's just look at levels of contribution. So again here by the different salary levels, at best we get to 16%. Now take off 1% for admin fees, 2 or 3% for insurance benefits. We're not saving the 15% that Stephen says we need to achieve a decent benefit, and every time we change jobs we're cashing in. So is it any surprise to us that the adequacy that we have in our system is that people are not retiring with reasonable benefits? So looking at fixing the problem, disclosures are awesome, and Wilma spends a lot of time running through those financial statements. How many of your members are reading those financial statements? Are they really adding value? Our problem in our industry is engagement. We need to get our members excited about their retirement savings. They need to learn Stephen's 4 things. They've got to be in there for 40 years. They've got to be saving 15%. They've got to be in a growth portfolio. And the other thing, don't touch your money until you retire. So I do think that we've achieved our regulatory target of reducing the number of funds. Treasury at one stage wanted only 100 funds. Is that where we should go? I think this is a debate. But the consequence of going there is we're going to have many, many umbrella funds, and that distance between the trustees, the employer, and the member who really counts becomes a problem. And so let's talk about that this afternoon. I think greater mandation would be great, but that reduces choice. So if you look at these high earners here, the high earners do not contribute to retirement funds, they exit. They hear things like prescribed assets. They look at these tax incentives. They look at the constraints of Regulation 28 and they say, I'd rather do it for myself. And we want those high earners in the system because they subsidize our entry-level workers who are in the greatest need of some sort of solution. So I'm going the wrong way. And then I just think the introduction of the default regulations, improving preservation, is a fantastic nudge. And I think well done to everybody on that one. So I think that we've got an interesting conversation around this costs journey and how quickly we're getting to the destination the politicians want us to be. And has competition in the market got us there? There are some new entrants into this market, but not enough. Part of this regulation has required that we are big institutions who can deliver that level of governance at a reasonable cost. It means we haven't created black industrialists in our industry, which is a real problem. Okay, we are not connecting with our members because we're not creating service providers who better understand our members. We have reduced complexity, but some of our presentations were very difficult to follow, and certainly, again, my mom's not going to be able to follow it. We spoke about how difficult it is to compare umbrella funds, and as ASISA, we've done a lot of work to try and simplify that, but I can tell you there's a proper bun fight in terms of how we try and do that. Policy uncertainty is a significant barrier to entry in our system. We need to solve that. I'd love us to have the next red book. Alano, maybe now that you've moved over from the dark side into the FSCA, we can have a maroon book, which is the next step in our journey to fixing and giving all South Africans a comfortable retirement. I think better disclosures there, but to me it's engagement that's the problem. And for the poor downtrodden insurers, trustees have given the insurers a tough time, and you look at all of their financial statements, they're all making terrible losses on group insurance markets because you're holding them to account. All right, so just much like the asset managers have good times and bad times, the insurers are struggling. So Alano, please hang in there in terms of your nudging.
Thank you very much, Rowan. And I think just to wrap up, ladies and gentlemen, I think look at the big picture. Look for those total expenses, because otherwise you don't get it. Let's get the balance right. I think we have to fix the cracks. The home needs maintenance in order for this industry to continue growing as it has been. It makes up over 108% of our GDP, sitting just under 5 trillion assets. I don't even want to mention how much is that in dollar terms. I think the answer from our panel today is collaboration, collaboration, collaboration. And this features very highly on the FSCA's regulatory strategy document on our website. So I just want to say we all have a role to play in this value chain. Let us keep each other accountable. And to my panelists, thank you very much. I feel very humbled to be in your presence today. And I think collectively, as I've mentioned, over 100 years experience, we can live forever. Thank you very much.
Sorry, before you guys leave the stage, Wilma, we're giving you an extra 10 minutes so you can continue with your discussion for the next 10 minutes. And the timekeeper will obviously monitor the time.
Thank you very much, Madam Product Director. Very much appreciated. So at this time, we'll take questions, maybe 2 or 3 maximum questions. If you want to direct your questions specifically to somebody or to our divisional executive, the team is here to assist with your questions. Thank you very much. If I can just see your hand. Yes, please. please go ahead. Just tell us who you are and then your question. Thank you. Yes, I'm waiting for the red light to be on. Sorry, just switch on so that I can see the red light there. Yes, just press the button. It's the one right at the bottom to your left.
I can stand and shout. Now, I'm the marketing from the Metal Industries Fund. We are Bagri Common Fund. We've got our own administrator and we've got our own pension fund. I agree with your cost measures. I can't speak to you because we are a non-profit organization in terms of the administrator and the investment asset management. The fees, you see the fees when we bring the financials to you. Look at our financials. The fees for the administrator is 5 basis points in total. No, sorry, 0.5%, 0.5, 0.5%. The investment cost is 15 basis points for the total fund of 30 billion rand, 350 members. The cost can come down. You've got people there in front that is driven by profit. You know, and then they come speak to us about how much we must charge our members. These are poor workers. This is the worst industry you can find in this country, in the world, where people come, they don't have no money, take poor people's money and become millionaires. The poor people stay in poverty. They don't move out of Kailicha, they still stay in Kailicha. I moved to Bishop's Court. So the fees does matter. The people that must make a change is the people who manage our money. They must make a change. They must change their minds. Especially I appeal to our black brothers who are professionals who are coming into the industry. Change, brothers. Let's change the life of our members. Reduce the fees, because the fees only benefit our members. If I get performance fee in my fund, don't reduce the fees. I don't get a performance fee, and I don't want one. So I just want to say, I don't know if it fits into this thing, but fees does matter. You know, the second one I want to talk about quickly is we're selling our members products that don't suit them. We bring the products from Europe and bring it here and say to a black brother, you must take this thing. Annuity, you must get into this thing, and if you die, your money stays behind. The guy doesn't want to leave his money there. We must develop products that suit our members. In our fund, what we've done, we have taken the annuity, given the member a spouse's pension, a child's pension, plus a guaranteed 20 years. That if he dies within 20 years, that money goes towards his family. So members are taking it up now, because if they ask me now, if I die, what happens? I say, if you die within 20 years, 5 years, 15 years of the money will go to your family. So I just want to appeal to us. We must just try to think out of the box. We don't ask why don't our members want to join these funds. It's because it doesn't suit them. In our fund, our members just leave and they go out for their money. They don't want to leave the money behind. Hopefully now they will leave the money behind. Thank you.
Thank you very much from the Metal Industries Fund. Thank you so much. We didn't really have a specific question, but just for the recording, what he was saying is he was looking at admin fees that are really not costing, benefit administration not costing that much. Maybe we need to get the balance right. Maybe reduce other costs and maybe go put the money where it really matters. And I think we can't forget that there is a profit motive. I'm just repeating for the recording. And then, you know, at the end of the day, our members are not retiring at a level which is really dignified, and we need to look at that. And then the final comment was just there on suitability of products. Again, don't sell members a cake they can't eat or that's going to give them indigestion. One last question, I think, from the floor before we wrap up, because now we're going to eat into your lunchtime. Thank you.
I just want to simplify the debate that we're having a paralysis of analysis in my case. We call it custom, we call it indexation. But for me, from the term of the time fund and our members, I think we always advocate is that when we feel paid as a fund and a member, so too must the service providers. There's no equilibrium in that equation. Because when the member suffers, the managers still get their fees. And I think the conference's theme is evolution of the South African industry. And I think one important thing is when you talk passive investment, then you must look at the research globally and locally. And what it tells you is that most active managers don't meet their benchmarks. So it actually tells you that there must be some action to balance of that. So you can come with all this semantics and words and all of that to justify your fees, but what is there in reality is impacting on our members. And we must see some action to say you're correcting it. And when you look at indexation and you look at the fees, and you compare 50 basis points to 10 basis points, it's a no-brainer that you go for something that's cheaper. And the risk is also there. So I just want to go in terms of the regulator and the policy maker. Firstly, about Regulation 28 and others. One of the things in the reform, they say that you have to consider, passive investment. And I think funds must do that and also try to mitigate the cost, because it does have an impact on our money. So I don't have the empirical evidence from a South African context, but I know globally, it's challenged as it says, that 15% of fund managers don't meet the benchmark. And that's a narrative that's big around the world and is gaining momentum. But in South Africa, we got this passive, active, alpha, beta, smart beta. I think we must be more direct in terms of what is the investment strategy to the last speaker's point appropriate to our members. It's just a comment. Thank you.
Thank you very much, and I appreciate it. And just again, I mean, this is quite an issue around paralysis of analysis. And again, the members, we are all in this boat together. If our members are in pain, so should we feel their pain together with them. And I think and really, if the regulation is required, we should do it. But I think what I'm getting from your points is that really knowledge is power. Let us start publishing this. Let us start closing this gap between those who know and those who don't know. And let's get rid of the Greeks in terms of alpha, beta, gamma, theta, rhesus. I mean, we're in South Africa after all. And let's make it proudly South African. Let's use plain language, because after all, the new Retirement Funds Act, Mr. TD once said to me, should first be written in isiZulu and then translated into English, because there is no even a word called prudential in the Zulu language. So I think let's take that pointer from him and really make it, I'm not saying oversimplify complex issues, but let us take our members along with us. Without their confidence in putting their savings in this pot, we all might as well go home. So can we end on that note, Madam Program Director, and I thank you all for your input.